And our featured guest is John Lynch from Evergreen Investments. John, let me start with you. And first ask you about really the economy, because although we had a boost from Alcoa earnings yesterday, we got those first-time unemployment claims in today. They were a little bit better than expected, but continuing claims rose. What do you see here?
Well, I see a lot of government spending, and it's been effective. And I think investors need to appreciate the fact that government spending can work. A weak currency can be additive to GDP. We've seen the inventory rebuild. We're seeing the resumption of auto production. Should be a spectacular third quarter. I'm just concerned that investors get caught up in the fact that that will continue, and I don't think that's going to be the case. I think it's a, third quarter probably see 3.5–4% growth, probably 1.5% growth in the fourth quarter.
Why is that? Because it's all about cost cuts and stimulus and not really about growth here?
Well, I think cost cuts would be more of a profit issue, but government spending has worked. We're seeing, again, exports and government spending being additive to growth. But I'm not going to be comfortable with, if you will, the legitimacy of the recovery until we see a ceiling on the unemployment rate, a floor in house prices, at which point then I think you start to see the consumer start to spend and businesses more willing to invest. And I think that will occur by the middle of next year.
John, we did see those signs that the consumer is beginning to spend again. We got those retail sales numbers. They did come in, better than we've seen in a long time. That's a good sign, but not necessarily the beginning of a trend in your view?
Exactly. I think when you see an X% increase, we always have to appreciate that X% of nothing is still nothing. And the consumer was so low that any sign of any hint of prosperity or any hint of spending, I'm fine with, obviously, but for it to become a trend, as you suggested, we really need to see a pattern, and I think we're not going to see that pattern until we get a floor in housing and a ceiling on the unemployment rate.
John, that's a good point. I mean, we talk about improvements in numbers, but if we recall where we were about a year ago, they're coming off some really, really low levels. So, yes, it might be an improvement, but still it's not great. To me, that sounds like it's going to take a while, maybe another year, until the numbers really show that there's some real growth out there.
Well, we've seen it in housing. We're starting to soak up some excess inventory. We've gone from, I guess, 11 months of excess inventory to maybe 8.5, 9 months. If we can get excess supply of homes for sale on the existing side of things, if we can get that to maybe 7 months, I believe we start to see home prices stabilize. And when you look at all the lag effects of monetary policy and Treasury steps and certainly the stimulus package, 2/3 of the spending kicks in next year, that provides a pretty good floor for the market at these levels, I believe.
What do you think about, John, the U.S.'s strong dollar policy?
Well, it appears that it's strong dollar in name only, because we're not really fulfilling that pledge, are we? I agree with the gentleman on the floor of the exchange in Chicago. The move in gold is probably more to do with the dollar. We've created a tremendous amount of liquidity globally, not just here by the Federal Reserve or Treasury, but also throughout the world. And I think you're also seeing a hunt, if you will, for hard assets that'll hold intrinsic value, and certainly gold, really the only commodity that serves as currency as well. So there is a bid there, and I think it will continue.
John, we're going to talk more about the dollar in about 15 minutes. We've got a roundtable coming up, but let me put this out to you. At what point do we become worried, more worried than we are about the dollar's decline?
Oh, we can start now. It's we're below 76 on the DXY, so I think that's something we need to pay attention to. But at some point, the dollar becomes a game of chicken. Somebody has to blink, because everybody loses with a weak dollar. And if Kevin Warsh's op-ed in the Journal a week or two ago was the first shot across the bow from the Fed starting to get creative in unwinding some of this easy policy, I think we'll start to see, I think certainly we'll see an increase in the Fed funds rate before the midterms. I think you'll start to see balance sheet management from the Federal Reserve get a little more creative in the first half of next year. And I think you're going to see an awful lot of speeches from monetary policymakers, that whether they're concerned about inflation or easy policy or federal spending, I think they're going to try to engineer the curve to move higher, so by the time they actually raise, it'll be an ancillary event.
Get back to John Lynch quickly here, just about a minute from the closing bell. John, let me ask you about the administration. Bill Gross has basically come out and said they have a policy of letting the dollar get weaker because they think, obviously, that exports should lead this recovery. Isn't that historically a bad bet? Don't you want a stronger currency to recover from this kind of recession?
I would agree with you entirely if we had not stared into the abyss a year ago. And I think that's, you never want to say it's different this time. But you're right, in an advanced recovery, a weak dollar is a bad bet. Where we are, I would say, in the incipient stages of recovery, we still have a way to go yet. So when you consider all that's gone on, we're still fighting deflation, and I'm amazed at how many investors just continue to ignore that. I mean, the headline inflation numbers are still negative on a year-over-year basis, and I think that's why you're seeing so much money being pumped into the system.
I want to get back to John Lynch. He's Chief Market Analyst over at Evergreen Investments. John, I'm noticing that one of the areas that you're cautious on is consumer discretionary. So that whole retail group, even though we're seeing some upbeat retail sales data today, you still don't like it.
Yeah, I feel like I'm in the non-consensus call here on the discretionary. So I'm programming throughout much of the day, and a lot of people like it. My biggest concern, a couple points. First, the technicals supporting it, we can't deny. So I think there's room to run. However, my second point is I don't think the profits are going to be there to support it. We're looking at a group that's up, 30% year-to-date, maybe 70% off the low. We're headed for an unemployment rate of 10% by early next year. The last time the unemployment rate was 10%, we had a Fed funds rate north of 10%, we had a prime rate north of 10%, we had a 10-year that was 12 or 13%. That was 1982. So as those rates all declined, that helped propel consumer activity. I'm afraid we've used all our bullets, so I don't believe that the consumer is going to be able to spend next year the way many people think they can. And, we just saw yesterday consumer credit contracted by $12 billion?
Right.
Last month, 2 months ago, it contracted at a rate that was 5 times worse than what was already a feared number by the consensus.
It's tough, right, for banks to do the lending right now? I mean, can the government do anything? The Fed obviously at zero already. Can the government do anything to convince banks to loan more? Do we even want that to happen?
Well, a couple things in the lending environment. First and foremost, the shadow banking system's toast. So half the lending market that we're used to is gone. The remaining half is lending on a more discerning basis. To your point about small business, the vast majority of small businesses that have been created throughout history have been built off the home equity line. You're not going to see that. So from that standpoint, from a job creation standpoint, that's partially why I'm concerned about the consumer spending habits going into next year. And I think the market is looking too favorably on the potential for the consumer to spend.
What do you think about the interest rate situation? I mean, you mentioned how bad it was in the 80s. I mean, now we're at zero and looking at deflation. What do they do? What does the Fed do here?
Well, the Fed's been extraordinarily creative. I was talking to a group of investors at lunch today, and we were commenting how, just 4 years ago, we were concerned about losing the market-savvy Alan Greenspan and to be replaced by an academic named Ben Bernanke. And I think Ben Bernanke has been extraordinarily innovative throughout this crisis, and the way he tripled the size of the Fed's balance sheet at one point, paying interest on reserves, taking on all sorts of assets onto the Fed balance sheet. I think there'll be a gradual unwind. As I mentioned earlier, I think the Fed will, if you will, talk up the curve, and I think there'll be a gradual unwind of the balance sheet, and as such, the market will interpret that as the Fed's ready to hike. Again, the Fed must assert, I believe, their independence before the midterms.
All right, hey, John, thanks for joining us.